amount. Okay, that's the academic program again. All right, well that should be visible to you shortly. It's obviously been set to delayed release. If you come on here later today, you'll be able to access the weekly solutions in this resource section also. All right, a few other just general housekeeping matters as well. All the submissions are online. I will enable Turnitin for those of you that would like to start using Turnitin. Would like to submit early. It's entirely up to you. I don't take the Turnitin scores as anything more than a useful indicator of whether you've cited correctly or not. All right, Turnitin is an entirely imperfect solution, but it's a useful starting point when figuring out how to engage in academic writing. It will show you if you've inadvertently perhaps co-opted someone else's material. Okay? So try to use that a little bit to guide your preparation to the extent that you find it useful, but don't take the score as anything more than just a broad indicator. All right? I'm just letting you know I don't personally peruse through any of the scores, but for your information, because I'm guessing no one else has disclosed this, if you submit something with a score that is consistently in excess of 40%, there is an automated system review that happens. And if through that machine checking it's discerned that someone needs to look at it more than a human operator will look at it, just as a matter of full disclosure. That's how it works. Okay. All right. So today we're covering off on what I would consider to be one of the more interesting topics. I personally think that they're all interesting, but I think to a lay audience or to a generalist audience, this is a very interesting topic, and that's the share market topic. And you're doing the course, as I said, at a seminal time, a very interesting time, by virtue of just how much change is happening within markets. I might just open this up very, very quickly. Do you know what? While I have your captive attention, I might just very quickly open up the rubric. I think it might be helpful. Okay. Just before we start. So apologies for digressing briefly, but this will be useful. Okay, so this is a copy of the rubric that we use. Obviously, it's to an extent automated. So some of the comments that you receive will be system generated. Because I like to set up the machine features and automation features to the extent that I can, and some of them will be custom, depending on the nuanced responses that are given. But as you can see, the assessment itself is very, very broad. If it's graded by me, you'll see my name attaching. If it's been graded by a colleague, you'll see my colleague's name attaching. So it'll be very, very clear who you should make inquiries to. But for all intents and purposes, all inquiries should be directed to me regardless. You'll receive marks, essentially 2 of your total marks, for an executive summary or literature review or introductory section. All right, so the goal is that you can take all of the complexity that's within your assignment subsumed into that longer narrative, that longer report, and you can summarize that into something a little bit more concise. So this is where we reward concision. All right, and you can see that it's a fairly good scaled system insofar as there are 7 potential score points within that framework. All right. You receive only 3 marks for grammar. The university actually wanted me to make that 10. This is supposed to be a preparatory unit, but I did feel like that was going to be a little bit unfair to people in the first instance. This is obviously the first unit for many, so grammar is only assigned 3 marks in total, but it is assigned some marks. If you do need assistance with this aspect of your report, we have an entirely free report writing and report review service that's run through Building LB and also the library. So you can make a booking with them for up to an hour at a time, and they will go through your entire report. All right, the next element, okay, it's framed as a series of questions, but in truth they're not questions per se. This rubric is essentially the rubric relates to those assignment topics that have a evaluation or analytic version. In the version where it's pure analysis, you'll find that the rubric terminology is slightly different. So there's some subtle variation in terms of the rubric structure depending on the assignment that you take. But for all intents and purposes, it essentially measures how you engage in the defining of imprecise concepts, and essentially how you go about the formal analysis within your assignment. So if it's a valuation-based assignment, it'll look at how you engage in the valuation. If it incorporates some regression, the rubric will reflect that. If, for example, it just looks at basic metrics and basic moving averages, the rubric will reflect that in the comment. But for all intents and purposes, this aspect of the rubric will analyze and evaluate the mathematical element of what you do, or the analytical element of what you do. Okay? It doesn't have to be complex maths, complex regression at all. Okay? The next part of the rubric will focus on how you frame your report. Okay, so this is the framing and structure of the report, and how you deal with the imprecise problem. So how have you actually made it clear to the lay audience what you're doing, or indeed the informed audience what you're doing, depending on how you view me, and how clear you've sort of made your focus and your intent. You know, is it apparent, and have you actually spoken to those issues? Okay? If there are relevant frameworks that need to be enacted or applied to your problem, have you applied them? Okay, this will obviously be more relevant to some, or I should say the second part of this rubric element will be more relevant to some than others, and the assessment will reflect that too. Okay, and finally, it looks at the broader approach that you've taken to responding. So has your response been well reasoned? Have you developed a sound approach to reasoning? Have you brought all of the imprecise concepts together and provided some sort of response? Because even the large, broad and imprecise questions will have some sort of summative element, something that brings them all together. So this final part of the rubric just focuses on that summation concept. I will release a few other iterations of the rubric so you can see how different types of assessments are varied slightly in terms of the rubric. But for all intents and purposes, the first section looks at the quantitative element. The next section looks at the frameworks, okay? And the third section looks in particular at your summation. So, for lack of a better description, again, just to sort of recount it in a very simple way, in the first instance, we're looking at analysis. In the next section, imprecise problem definition. And in the third section, reasoning and summation and analysis. All right, so that's almost like the assessment of your summative remarks or conclusion section. Okay? All right, let's jump into this week's material. As I said, I think that this week's material should be interesting for most of you. Those of you that don't find it interesting, well, it doesn't get too much more interesting than this over the course of the entire semester, so enjoy it while you can. You wait till we get to monetary policy. There's a reason that everyone in economics that thinks Ben Bernanke and Alan Greenspan are cool, and that no one outside of that community knows who they are. All right? So rest assured that session will be worth the entirety of the fee that you pay. All right. With that said, let's make a start. So what I'm going to do today is just go through some of the initial concepts relating to the corporate form of business organisation. We'll then spend some time going through how exchange mechanisms work, and then we'll finally devote some attention to, I guess, the part of the people that are quite interested in valuation, trading, how modern traders engage with markets, and indeed some of the complex challenges that you're likely to encounter by virtue of the use of system automation, in particular in high-frequency trading. Again, I don't think people devote enough attention to that discussion, but we are, okay? Even if it's not in academic discussions enough, you guys need to be aware of it. People don't think it's an issue, but it really, really is, okay? And you need to be well equipped to deal with it. I love the response that was given by a couple of major heads of bourses and exchanges. I don't know if you follow the market's discussion around this, but several, I guess, active proponents of a laissez-faire or non-regulated approach have contended it doesn't really matter too much at the moment because it only represents 30 to 40% of trading activity. And kind of remarkable. Doesn't matter that much. because it only represents 30 to 40% of trading activity. We're going to explain why it's such a seminal issue, why you're in this seminal moment, and indeed how traders are likely to respond going forward. Okay, because these are the markets that you guys will be operating in, far more difficult markets to contend with than any of the markets that have come before. Okay, I think I've often started lectures by talking about the naivety of every generation, talking about things that have never happened before, like they're new things. Well, this is a legitimately new thing. All right, legitimately new, and we all need to be prepared for it. And it's only going to get worse. All right, so in this lecture, and come the end of this lecture, you should be comfortable with the nature of the modern corporate form of business organisation, and you should come to terms with why firms list. All right, we'll talk about the primary market and secondary market roles of, well, I should say within the markets. And we'll explain the distinction that exists between derivatives and non-derivative securities and the role of derivatives in the context of risk management. We're also going to spend some time talking about electronic trading and settlement systems. You're not going to be examined on that element, though. Please bear that in mind. You'll never be examined on history in this course, but it is something to be mindful of. And then we're going to talk about the importance of informational flows, particularly in the context of modern markets. We'll then spend some time talking about regulators, and even though that is a fairly arcane subject, for the most part, it is something that you do need to be familiar with and you will likely be examined on. So regulators matter, and you need to be familiar with what they do. All right. So let's spend some time talking about the nature of the corporation. I think in recent weeks, we've devoted time and energy to understanding the origins of the corporation, so we're not going to harp on that too much, other than providing, again, for lack of a better description, a bit of a summary, a bit of a précis, for those that haven't been able to attend the earlier sessions. So, why do we have the modern corporation? Why does it exist? And what was the first modern corporation? Think back to a few weeks ago. I think we've already talked about this ad nauseum, so the faster we can get through this dialogue, the better. All right, so which entities were the first, or considered the first modern corporations? Did we talk about this, guys? I think we did, didn't we? Did we? Help me out. Yeah, I think we did, Ron. I think you told me the answer. Do you remember? No, I don't think you have. You told me the answer, week 2. Everyone remember? Listen to Ron, he's a smart man. He gave you the answer and you weren't paying attention. All right, so the modern corporation in its current conception has probably only existed for several hundred years, but in truth, people frequently make reference to the first truly modern corporation as being the Dutch East Indies Trading Company. This is largely because prior to that point, most joint ventures didn't exist in any sort of enduring way. They had a defined purpose, they would engage with that purpose, and then they would cease operation. With the Dutch East Indies Trading Company came this desire to create and perpetuate an enterprise model, an organizational model that was ongoing. It gave rise to that notion of a going concern enterprise. All right? We then saw a number of other super conglomerates and super corporations enacted, adopting a very similar model. The goal was to establish a trade passage between their origin location and India because of the importance of India in the context of trade and commerce at that point in history. All right? Why are these corporations so important? Because in truth, in reality, no corporation has in any way been able to approach their scale. Okay? Even though we think of modern corporations as being significant, as being remarkable by virtue of their size, nothing comes close to what those enterprises once were. Several of them, not 7 of them, several of them were given nationhood status. They were effectively deemed to be countries. Okay, that's how large and significant they became, which meant that they had an equal place in international negotiations and arbitration. All right? Companies that were effectively countries. Okay? Obviously, we've come a long way since then, and we've refined the model somewhat. We don't really give nationhood status to companies anymore, which is probably a good thing. But the reality is we do see great benefit in the corporate form of organisation. It's not an inherently bad thing in its modern conception. It's actually a useful thing for the most part. It provides individuals and organisations that have chosen to enact this form of enterprise with the ability to raise ongoing capital, with the ability to support a going concern enterprise, and with the ability to ensure perpetual succession. That ownership doesn't cease with a given ownership group. Right, these are very useful benefits. When were the first bourses and exchanges created? Well, the first true bourses and exchanges were probably established in Europe. Okay. Some would contend that they may well have been established in parts of Asia, because there certainly were comparable models in place in India and China. But in terms of recorded history, it would suggest that the first bourses and exchanges were likely to have been in places like Holland and Germany. It would appear that Holland is likely the origin point for many of the modern bourses and exchanges and auction houses that we've now, I guess, come to take for granted as business models, because the world has changed so much. And so these first auction houses facilitated as a mechanism through which people could buy and sell equity. All right. So equity was often bought and sold in a very auction-like manner when it was put up for sale. It's kind of remarkable to think of equity sold that way. Essentially, people would represent the equity that they own in the context of the auction process, and it would be presented to a group of bidding entities, bidding organisations and individuals, and they would seek to acquire the equity. All right, it's a somewhat inefficient model, to the extent that you need to present the equity at a defined point in time. It needs to be valued at that defined point in time, and it was only going to be made available at that defined point in time. And so the model was refined somewhat, and we saw the establishment of more modern implementations of bourses and exchange within the United Kingdom, whereby equity was represented on a daily basis on the formal bourse, and people could approach it, they could actually interact with it, and they could acquire equity at any given point in time. Okay, so it was taken from a defined sell point model, from an auction model, to an ongoing exchange model. And we've seen that model refined somewhat. The earliest bourses, the earliest exchanges involved open outcry, people yelling at each other on a trading floor to buy and sell given securities. They would open at 9, close at 5, and that would be the extent of it. You needed access to the bourse or to the exchange to actually facilitate a transaction. With the advent of the telegram, telephonic transfer mechanisms, and the modern telephone, people could all of a sudden trade in securities from a foreign polity, foreign domicile. But nothing is as dynamic as the systems are now. By virtue of access to the internet and the availability of a computer, you can trade in securities from anywhere in the world, and people do. The most popular markets in the world at present in terms of IPO activity and IPO interest are China and India, but a huge amount of the interest in investments in those countries is coming from outside of those countries. Okay? A huge amount of the impetus behind the IPO activity in those countries is actually coming from abroad. All right, so in Australia, we actually have quite a substantial bourse. We have quite a substantial exchange. The Australian Securities Exchange represents over 3% of global equity at this point in time. And when you consider our population, when you consider the age of this country, it's kind of a remarkable metric. If we had the equivalent population of the US, for argument's sake, our equivalent holding would be well in excess of 30% of global equity. So we really do have a substantial endowment of equity in this country. And as I've mentioned in the past, one of the key reasons for that has been a process of deregulation that has been realised over the course of recent decades. And also, it's been driven to an extent by superannuation, the availability of superannuation funds and the need to put those funds somewhere. All right. So when we talk about a share, an ordinary equity, what are we actually making reference to? So what are you talking about? What is a share in something? Yeah. Sorry? Yeah. So and so that represents ownership. Okay, so effectively it's a divisible unit of ownership that you can trade quite readily on any major bourse or exchange within the context of a given company. But that notion of equity, an equitable interest, an equitable stake is actually a much broader concept. It comes from Elizabethan law. It's hundreds of years old. It comes from a broader stakeholder concept. If you had an equitable interest in something, you weren't, for all intents and purposes, an owner under the old definition. But when we use the term now, there's a very modern conception, a very modern definition. And so when we use the term stock, we use the term equity, when we use the term ordinary share, we're making reference to a specific subunit of ownership that we can trade. The benefits and the rights that attach to that subunit of ownership are really contingent upon the class of shareholders and the class of shares that we're actually looking at, what they're able to do by virtue of the rights that attach to that security. And they can vary markedly. All right, within the Australian system, you'll find that there are limited liability companies, okay, and there are no liability companies. Let's take a moment and consider why we operate this distinction, why this distinction exists within our system. Why is that the case? Most certainly, that's exactly right. Look, a number of jurisdictions adopt similar models, but we in Australia allow for classification under a no liability model when there is a particular risk level attaching to the enterprise. And this model is lawfully supported in the context of one particular type of organisation, one particular type of corporation. What is that? What is the type of corporation? That's exactly right, mining and exploration. And that's because we believe that to be an inherently risky venture. We do have the need for those investment funds. Someone needs to speculate, with respect to, in relation to whether something is out there. So someone needs to put up to ensure that we can actually engage in that process, but it's inherently risky. And so for that reason, we allow mining companies to adopt a no liability model, which means that in the event that you've chosen to invest in the company initially, but there are still monies they could conceivably call upon to complete your investment, you can choose to forego that opportunity. You can choose to not parlay or provide the additional money because you believe the venture to be too risky given what you've discerned about the project. So that happens a lot in the mining sector, but we don't really allow for that model in other contexts. All right, so I've talked about the advantages of the corporation ad nauseum at length, so we're not going to dwell too much more on them, but I want you guys to appreciate that there are some significant distinctions that we should draw between, for lack of a better description, sole ownership models, proprietary limited models, partnership models, and the modern corporation. The modern corporation is the only model that provides the degree of flexibility to raise ongoing capital in particular. That's the key point of distinction, as well as that separation of ownership and control that I've emphasised. All right, so historically in this course we spent time talking about the agency problem as well. I'm not going to dwell on this too much because this is not a course in the management sciences. You've all learned this before. I've kept the slide in here simply because I guess to not share this with you would be an omission, but we don't need to dwell on it too much. But can anyone tell me anything about this? Why is the agency problem an issue or a greater issue with this model relative to other models? Just thinking back to Management 101. When owners are also managers, there is no separation between ownership and control, and so by virtue of the owner pursuing their rational self-interest, they're always going to be pursuing the interests of the firm and vice versa. There is no separation there. They're one and the same. When a corporation is constituted, specialists more often than not are put in leadership positions, and that can give rise to some complexity because they can often seek to maximise their own returns at the expense of other stakeholder groups. I'm not sure if this is recording properly. Just need to make sure that it is. I'm going to stand a distance away just to check that it is. It seems like it is. Okay. Very, very low though. My sincerest apologies to those of you that are at home. I might need to switch recording devices at intermission. All right, so what are some examples of this separation giving rise to issues and challenges? Well, quite frequently, managers can actively pursue models that generate profit in the short term at the expense of wealth maximization. So sometimes we talk about profit maximization versus wealth maximization. Profit maximization is the active pursuit of the highest conceivable gain within the current interval. Wealth maximization is a little bit more broader as a construct. It focuses on actually generating enduring wealth within an organization, within an enterprise. You might quite rightly respond with, well, I would assume them to be the same thing, but there is a difference. We can pursue profitability in the short term at the expense of long-term wealth. I'll use an analogy or a good representation. Anyone ever played with a BlackBerry playbook? No? What about a Kindle? Kindle, yeah? So the Kindle Fire HD and the BlackBerry playbook are the same device. They were made by the same OEM manufacturer in China, same manufacturer that produces a number of Apple products using the same componentry. And when you hold them both, you can't really tell the difference, all right? The BlackBerry playbook has a BlackBerry logo on the back and the Kindle has a Kindle logo on the back. That's really the only major distinction. One unit was released at a price point of $399, okay? And the other was released at $149.95 in the same year. How can two products be so different? How can two products be so different, released at such different price points when they have identical underlying specifications and for all intents and purposes are the same thing? How can they be released in such a different way? Well, that's exactly right. So the Amazon model is a model that's sort of strongly aligned to generating subsequent earnings through digital unit sales. People buy a Kindle, and then they buy a lot of digital books. How many of us own a Kindle? Okay. All right. Rest assured, many of you will be buying Kindles over the course of the coming years with the Amazon marketing that's going to be pushed forward at you. With that said, how many of you bought the BlackBerry product? Look, I'm into tech. It's one of my few vices. So I own random gadgets, so I own one. I gave it to my daughter after about 3 months, so I did buy it for her while we were away. The reason I love them, and the reason I love both of these devices, is because I think they sort of represent a seminal moment in business. This realization that this business is changing markedly. You can't adopt a high per unit sale model when other people are adopting such heavily subsidized models. The Google product, the Amazon product was a loss leader, wasn't it? Or it was released at a very low margin with a view of generating subsequent sales. The BlackBerry product was released at a per unit margin akin to an Apple type margin. And they were able to generate good returns for a good amount of time enacting that model. Their margins are around 48.5%. Okay? Apple and BlackBerry are the only companies that have ever released products at any point in history with such, actually that's not true, I would say with any enduring success at such high margins in the consumer electronics space. All right? But if history is any guide, it's not a very good long-term strategy. Okay, you might maximize short-term profitability, but will you win the long game? It's a very different question. All right? Think back a few decades ago. Think back to that moment in history when Amiga tried a similar business model, and Commodore and Amiga being the same group, and the Commodore 64 was released under a very similar business model, and those business models sought to compete with lower per unit pricing that was supported and subsidized by subsequent software sales. It's really hard to lay claim to the fact that in the long game, when pursuing wealth maximization, those sorts of strategies actually work. And so that's what I want you guys to think about, all right? Try to think of that example if it helps. Okay, and if it helps, think of me, the only BlackBerry Playbook owner in the world. Okay, I was the only person that bought one. All right. In my defense, it came out about 6 months before the Kindle did. All right. So, something to be mindful of. All right, so moving on. Wealth max. That's an excellent point. I think if we want to sort of look to the agency problem, we should probably look no further than the financial services sector at present, because there are so many examples. And for whatever reason, the AMP has copped the most. I mean, they probably have done some things that most of us wouldn't have expected. I do feel for the AMP because they're copping it on all fronts, and I do like that the business sort of dialogue around this issue is, the big banks and AMP. So they often get singled out as not being one of the big banks. But in truth, they probably have been the worst, haven't they? We've come to discover that they've pursued profit in an unabated way, quite frequently, at the expense of those that they were seeking to serve. All right? And it is a really good example. So think of, for argument's sake, those individuals within an organisation that are remunerated based on profits, or for argument's sake, remunerated based on contract units. Okay, how many contracts are you bringing in? Are we concerned about the long-term viability of those contracts? As someone that's consulted to a number of failing transport companies, it's often the case that a new manager will come into a transport company and try to generate as much business as he can by undercutting everyone, without actually discerning whether or not profits are being made in those trip runs. One of the first things that I did in the transport sector was actually try to create a transfer pricing model and a subcontractor model that would ensure better profitability for the sector. What you come to discover is the sector is often led by people that are only concerned with perceived outcomes rather than actual long-term gains. And this is largely because of the level of contestation within that space and because of the simplicity of the business model. And so many major transport companies in this country have fallen by the wayside or been acquired by the Toll IPEC Group or Linfox simply because they've been running at a loss for so long. We're not talking about small losses either. All right? Many of the leaders within these organisations, well, they're remunerated on the basis of revenue and the contracts they bring in. And often, they don't discern in the short term whether those contracts are profitable or not. So it is a major issue. These things might seem like they're really obvious things, but they happen again and again and again. And as I said, AMP is a good case in point. I think BlackBerry Corporation is another good case in point. People are actively pursuing short-term gain at the expense of the firm. Yep. No, look, undeniably, and we could almost do an entire course on this banking sector financial services inquiry, because we've really learned some very unfortunate things about our sector, and one is that there is a largesse or an excess mentality, and people are not as concerned with the interests of consumers as perhaps they should be, and undeniably so. But I think that the onus is now on them, and I think that there is a far greater level of expectation being assigned to financial services participants, and we will talk about that in due course when we get into banking more. All right, so some of the disadvantages of the corporate form of organisation. The investor's ability to sell shares in the company causing the price to fall. Well, I don't see that as an issue. Okay, that is standard kind of textbook economics, so we do talk about it here, but I personally think that that's a good thing. I call that market discipline. If you do a bad job, people don't want to own units in your company anymore. But from an insider perspective, it is a real risk. And market discipline is significant in most efficient markets. People do opt out quite readily. I've seen that happen quite a bit in recent times. Some of my favorite enterprises don't exist anymore for this reason, or indeed don't exist in their original form. Nokia Group was one of the oldest ICT companies in the entire world. One of the few truly enduring ICT companies. Now, we think of Microsoft and Apple as being old heads in the industry. Okay? Nokia was over 140 years old. Okay, it's a big, big difference. It's been in so many proximate industries. And you look at the modern incarnation of Nokia Group now, and they're effectively an IP holding company. And the market is very quick to bring discipline. All right. The threat of takeover and loss of employment, use of performance incentives such as options, and more rigorous corporate governance. Look, undeniably, these are further forms of discipline. Right, the threat of takeover is a significant one. All right, if you perform poorly enough, your price becomes small enough such that someone can generate sufficient capital and buy you out. What are some good examples of this? Let's think of some recent examples. Yeah, very, very good. Two really iconic brands in fast-moving consumer goods in this country. Arnott's, Campbell's Group, I guess, for lack of a better description at the time, were both very, very prominent Australian brands, but because of what was perceived to be a degree of underperformance, they were both acquired, albeit under slightly different circumstances. Any examples of this, though? Company performing poorly and being acquired as a consequence? Yep. Yeah, many of the American banks during the GFC, unfortunately, were considered underperforming enterprises and were acquired. In Australia, you might recall seeing advertising on television late at night where a big RAM comes out and starts talking about banking products. Ram's Home Loans. Okay, who owns Ram's Home Loans? Sorry? Well, they were acquired by one of our big four post-GFC simply because they weren't able to recapitalise. In the GFC environment, they'd secured a number of loans from North America very, very cheaply, but in a post-GFC world, they simply weren't able to renew and roll over those loans, and consequently they were bought out. Okay, it's an all too common story. All right, this is where it gets a little bit more interesting. I'm very, very big on math, but I actually think history counts for a lot more. Let's think back to the start of the New York Stock Exchange. Some of those major brands from back then. Industrial Rubber, Allied Foods. Okay, think of those iconic brands from that bygone era. Okay, of the first 23 enterprises listed on the New York Stock Exchange, how many of them exist today? This really makes it feel quite stark and quite confronting. None. Or one, if you consider Quaker Oats as being Allied Foods. I guess you would say one. So that just puts it into perspective. How frequently firms can perform well, but then go through a term of underperformance and then just get gobbled up by somebody else. To create something that's of true and enduring value, you need to do something that's truly remarkable. But companies are doing things a little bit differently now. Okay? You'll note that Apple Corporation hasn't paid dividends, or indeed didn't pay dividends, for a number of years. Neither did Google. Anyone tell me why? A lot of people will argue, well, with Apple shareholders, you don't really need to. All right? They love the brand. They're happy to just own the shares and put stickers on their cars. All right? That makes them happy. Okay, I'm being a little bit facetious, but there is a little bit of truth to that too. There are unique segments. So Apple fans, Google fans, brand fans, are different when it comes to investment attitude to an extent. But the vast majority of owners in Apple Corporation, rest assured, are not necessarily Apple users. They're venture capital groups. Okay, they're very large, how do I put it, investment groups that represent substantial holdings. And they weren't happy about these decisions, Google not paying high dividends and Apple paying no dividends at all. Why were these enterprises not engaging in a strong dividend program? Any thoughts? I've talked to you guys about this briefly already. Because it's important that you look at the companies that you love through a very accurate lens. Okay? Well, that's exactly right. It's odd because they've gotten to it, their holdings have gone to a very extreme point. Even Microsoft's holdings have gotten to an extreme point. Okay, but why is that? Why are these modern corporations doing something? Maybe it's because they know something that everyone else doesn't. And that's that if you don't hold this wealth, there will come a point in time in history where a non-incumbent rises up and competes with you. I mean, it's happened in recent times with Facebook and Google, and contests your position. All right? These are not old enterprises, but they've learnt. What happened to Apple in the 80s that has resulted in them being very conservative when it comes to dividend payments now? Not so much a Murdoch-related issue. Well, they're trying to become a little bit more diversified, but the perception and the reality of many modern corporations is very different. Apple Corporation has never been a strong internal innovator, as much as they're perceived to be. The vast majority of the intellectual property is acquired through acquisition. They have a very small R&D program. The three biggest innovators in terms of R&D generation are Microsoft, Samsung, and IBM. IBM being the largest, and they have a very strong licensing program. Apple probably ranks somewhere between rank 28 and 35 in terms of American corporations. Google ranks somewhere between 20 and 25 in terms of IP generation. Okay? They've tended to acquire and integrate enterprises very, very strongly. So everyone has Siri on their phone, right? Their iPhone. What are the origins of Siri? Anyone tell me? Who made Siri? Help me out. Can't sneak in the room and then pretend like I don't know you guys are there. Yes, you don't act like you don't know. Come on now. All right, they're being humble again. All right. So Lorman Houseby produced the original intellectual property that became Siri. Lorman Houseby went through a huge number of issues because there was some internal embezzlement going on and very, very poor management. The owners got very, very wealthy very, very quickly. They made about $115 million in 2 years. When you've never generated wealth before and that happens really, really quickly, it can change people. And all of a sudden they weren't engaging in an innovation program. As a result, they became insolvent. They were acquired by a company called Nuance. And what does Nuance make? You're investing people's money, Calvin. You need to know this stuff. All right. I'm going to call Deloitte Financial Services. All right. Nuance makes the Dragon speakeasy range, right? And they make a number of other products. They made the first speech technologies for Apple. And then, when Apple wanted to create their personal assistant, where did that come from? It came from intellectual property that was purchased from Nuance. Okay? So who first invested in Lorman Houseby? Samsung and Microsoft in the early 1980s. The first voice-based digital assistant on a phone was on an early Samsung enterprise phone released in the 90s. Okay? The technology that you all now know and love. Very, very, very old technology that's been through 4 sets of hands to finally get onto your device. Why am I telling you this story? Well, during that time, in the 80s, Apple Corporation went through a really, really difficult time as well. What happened to Apple Corporation in the 80s? The same thing that happened to Amiga. Okay? Amiga was probably the most innovative IT company of that generation, by some distance, in terms of GPU technology, concurrent processing, parallel processing tech. None of the other computers were really close. Okay, but they still lost because they couldn't sell units. Okay, and they weren't able to leverage their innovation terribly well, and they went under. Okay? The same thing was about to happen to Apple, but what happened at the 11th hour that caused Apple to be saved? They lost a lot of employees. They hadn't made a profit for a number of successive quarters. But who stepped in? Microsoft bought 33% of the company. The only reason that company exists today is because Microsoft bought them. It's a weird irony. It really, really is. Microsoft didn't even take them over in full. All right, they acquired 33% of the company. Okay, and they gave them close to $1 billion equivalent loan to see the time out, and they agreed to make the Office suite of applications on a committed basis for a term of a minimum of 5 years, and then they extended for another 5 years. Okay? Why do you think Apple's saving money now? At a very high level, it never wants that to happen again. It never wants to be at the behest of a rival. Okay? The biggest proponent of bringing Steve Jobs back and the entire Next PC IP portfolio was Bill Gates, not the Apple investors. The Apple investors were the ones that ousted Steve Jobs. Bill Gates was the one that pushed for him to come back. Kind of remarkable. Even though the modern narrative is so different to that. When you look at the modern narrative around these corporations, so different. You know, one of them is seen as a traditional conglomerate, whereas the other is seen as a largely innovation-driven firm. And so what I want you guys to appreciate about that narrative is that modern corporations appreciate things that early stage corporations didn't. And one is that continuity is a real challenge, and that something can happen that's truly remarkable and iconic and change things up. Okay? Rather remarkably. So the holding levels of modern corporations in terms of cash are far greater than earlier corporations. All right, another good example I want to talk about briefly is Facebook. Let's take a second and talk about Facebook. Someone needs to talk about Facebook. Remember 2 weeks ago I talked to you about the fact that they're doing better, but gosh, isn't their share price kind of crazy? Kind of crazy. Remember we spoke about that? I'm sure all of you are thinking at the time, Michael doesn't know what he's talking about. I use Facebook every day. All right? Facebook is a great company and they're really valuable. I don't disagree with you. I just think that I thought they were grossly overvalued based on their earnings levels. Okay? Some companies can get away with it for a time. You know, Apple has, but its earnings have improved relative to price. Google has, but again, even its price and earnings multiple has softened. How long can you run a really high price to earnings multiple without people expecting something? Okay? What happened? What happened last week? Only it all shorted the company when I told you to. You've retired already. In a week, share price absolutely plummeted. 128, how much? Not million. $128 billion was wiped from the price in the last 2 weeks. So I think the market is kind of agreeing. The market has kind of come to terms with the fact that things aren't as rosy within that organization as they're perhaps presented. So what's happened in the context of that organization? Are they a takeover target? No, well, they're way too well capitalized to be a takeover target. But rest assured, they keep underperforming, and venture groups will gradually start buying them up. It's happened to Apple, happened to Google, will happen to them as well. That's an excellent question. That is such a good question. How come Amazon can get away with it? Okay, I'm going to put it out there. I'm a big Jeff Bezos fan. All right? I'm going to be honest. I think Jeff Bezos is a brilliant leader. He's doing some amazing things. And after the Elon Musk craziness of the last month, he's kind of fallen a few rungs in my estimation. So I'm going to put that out there. Maybe I'm biased. I like to declare my bias. But why is that? Why do you think Amazon can do it? We spent forever and a day talking about it. I can recall in earlier iterations of this class, we would go through valuation models for Amazon relative to other non-Amazon corporations. We would have non-standard valuation models for Amazon. Okay, Damodaran, okay? who's far more well known in the field of finance than I am. He's probably considered the global leader in the corporate finance and valuation space. Professor of economics at New York University. Professor of finance at New York University. A very, very talented chap who originally went to IIM Bangalore or IIM Chennai. So very, very talented individual. He's been talking about this a lot. How we value Amazon, why we should value Amazon. And he's actually released 7 different models over the course of 2 years. So even he's not very sure. All right? All of us offer different conjecture, but it's a really important question. Why do we value modern corporations differently? Calvin hates this question. I ask this question a lot. Intangible and incorporeal assets, okay, and network value. Intangible and incorporeal assets and network value. I used to always make students do questions on intangible and incorporeal asset valuation, make you value something really complicated, and try to explain why the market is valuing it the way that it is. That's a big part of it, but Amazon is an extreme case. Because they are not making the earnings to justify their price. No way. Love it. I absolutely love that. I love that. People, when they engage in evaluation, when we engage in this conjecture and discussion, we're very short-term, we're very pessimistic, we're very intertemporal in the way that we engage in this kind of valuation and discussion. But the reality is valuation should be long-term. The valuation should represent a long-term representation of the underlying value of the firm. Yep.
There are some other factors as well, like acquisitions and mergers, corporate governance, which affect the organization. Like it has recently acquired Flipkart, which is one of the biggest
in India, yeah.
And Amazon has acquired it. So these factors also predict the future of the company.
No, undeniably, yeah. It's all-encompassing. That valuation represents what everyone think about the firm. It's the only true democratic way to assess any enterprise, how much the market deems it to be worth. But the reality is we have different rules for different companies, don't we? In terms of price to earnings multiples. And Amazon seems to be in an entire league of its own.
Wouldn't some part of the justification for the valuation be the fact that they exert a lot of political influence?
Quite possibly.
So they get away with a lot.
They are quite influential in a number of different markets, without a doubt. I mean, but from my perspective, I think that people are really taking a long game view. And it goes back to that initial discussion when we compared the BlackBerry and Facebook models. BlackBerry was a really strong brand. It was an Apple-level brand. Okay, its brand awareness in Asia and parts of Latin America was actually stronger than all other tech brands. It was actually the strongest and the most iconic brand, particularly in enterprise, for a very, very long time. But the reality was its model was driven very much by a limited level tie-in. Essentially, it's push-based email model and a few other BlackBerry Messenger-based features. And most of its margins were made through selling units. So its refresh rate and refresh cycle was critical to its profit model and its long-term profitability. So it needed to refresh its product line with great frequency to generate sufficient product such that its valuation was going to be sufficient. If its refresh cycle and per unit sales weren't sufficient, its long-term valuation was going to be affected. And many modern businesses are like this. Samsung's business model is driven very much by a refresh cycle. Apple's business model is driven very much by a refresh cycle. They have the wherewithal to maintain a refresh cycle with sufficient confidence such that they can keep generating adequate profit. Other companies haven't been able to. Okay? Or people have fallen away in terms of their profit, their product and their profit level has fallen as a consequence. Have you guys been tracking HTC? What's happened to HTC?
Recently, there has been a lot of change, fluctuation in share.
Yeah, so they've gotten rid of another 5,000 employees after getting rid of 5,000 over the course of the last 2 years.
And the retention level of the employees have been fallen from...
Very, very low. So HTC was probably one of the first producers of OEM, ODM phones abroad. One of my first phones, a GoPod, was made by HTC. Again, their profit model is driven by a refresh cycle. Okay? It can work exceptionally well if you're a popular brand. But how does the Amazon model differ? What's different about Amazon? I like using the expression, there's a long game. Okay? The greatest skill that you can acquire in a business course and in life in the short term, outside of having well-orientated faith and values, is this one very, very simple thing. Acknowledging the benefit of deferred gratification. Not getting all of your returns right now. Okay? That is the reason that Amazon is valued the way that it is. They understand deferred gratification. Their long game is better than anyone else's long game right now. 1 in 20 North American digital sales is an Amazon sale. 1 in 20. Think about that. All right? 20 sales, 1 Amazon sale, 20 sales, 1 Amazon sale. How many retailers are there competing for unitized sales, digital sales in North America? There's more than 20. All right, let's put it that way. Okay, so their long game is better than anyone else's long game. They're a really, really good representation of how the market views an enterprise that has long-term wealth potential. As an aside, Jeff Bezos has passed Bill Gates as the wealthiest person in the world. But thankfully, from what I can gather, he seems like a fairly charitable person as well. Bill Gates is no longer up there because he's obviously donated the vast majority of his wealth. So has Warren Buffett. They've endowed it into a fund. It's worth over $100 billion now. Bill and Melinda Gates Foundation. All right. We're going to go through this slide deck, and then shortly after the break, we're going to have a couple of brief plenary sessions around some discussion points that Calvin and Rahul will be raising, and then we're going to be doing lots of questions. All right? This shouldn't take too long. All right, we're now going to be talking about the different market contexts, and we'll then get into some valuations. All right, so the primary market role of the securities exchange is an obvious one. It serves as the initial mechanism through which securities are made available. All right, so when we make reference to the notion of a primary market, we're making reference to the fact that it is the market for the first issuance of securities. Okay, so we're making reference here to the stock exchange. Sometimes people assume that primary market references make reference solely to equities. The reality is we're talking about any securities issuance. So the first issuance of any new security or class of securities could be classified as an IPO. All right, so if it's a debt tranche going to market, that's still an IPO. All right, what are some of the other mechanisms through which initial capital can be raised? Rights issues, placements, and dividend reinvestment plans are popular mechanisms within this country. Dividend reinvestment plans are very popular here because there are a huge number of super funds that invest heavily in our markets, and this is a great mechanism through which they can provide gains to their investor groups, and indeed those that hold super with them. All right, so what is a rights issue? What is a placement? A rights issue is essentially the assignment of rights on the basis of existing shareholdings. It's a great way to provide equity to your existing cohort on the basis of their existing holding, and as a result, not diluting existing equity. All right, you're not diluting their existing holding. They can maintain the same holding level. All right, what is a placement? You can't do this in every country. Okay, you can certainly do it here. Yeah, a placement is essentially the assignment of a tranche of equity in this country. Up to 10% of equity can be placed on an annual basis with a given investor group. All right, why do you think someone might do this? Why might they choose to place a tranche of equity with a preferred investor group?
Because the decision making would be confined to a particular level of people, set of people, so that they can participate in the future prospects of the
That's certainly an admirable way to be looking at it. I'd say that is the best case scenario, that people are placing equity with preferred investor groups because they want those investor groups to be key decision makers. They want them to influence the direction of the company. It happens quite frequently. With Google and Microsoft in particular. They take strategic stakes in a lot of companies with the view of directing companies. Okay? So Microsoft had an early stake in Netflix, had an early stake in Facebook. 10% in each case. All right? And I dare say they were probably pretty stupid not to buy Netflix, to be honest. When they were able to buy the entire enterprise at $2 billion, it probably would have been a fairly smart purchase, one that they probably regret. I'm not sure if they were given the chance or not, but good example. Strategic investment. The reality is it happens for a number of different reasons. Sometimes it will happen because we don't want to deal with small shareholders, because they're very difficult to deal with, relatively speaking. Does anyone listen to a shareholder call? Okay, you should go down to the securities exchange or watch the live feed when they do a shareholder call. There'll be a lovely old couple that will come down to the Bilton call, for example, and they will let those leaders know what they think, and they will be given the platform and the vestibule, and no one will mess with them, because in Australia we let people speak their piece and speak their mind. They're representative of a large cohort of investors. I think they should be participating, but the reality is the market participants, the key players, would prefer to deal with institutional investor groups because they're easier to service and easier to deal with. All right? That's one reason. Another reason is often to stave off acquisition, which is quite disingenuous and technically it's unlawful. But without a doubt, it does happen. So if you place a large tranche of equity with a preferred shareholder group, it makes it very, very hard for you to be acquired. Under the Australian system, okay, we have creeping bid provisions which allow you to acquire 2% and 2% and 2%, and gradually build up your holding. But that sends strong market signals, which causes the share price to drive up. Makes it very, very hard for you to acquire a company. Beyond that, you have to make mandatory bids when you hit a 20% threshold. For a long time, I've wanted this threshold to be 30%. I think a lot of people do because it increases the likelihood of successful takeovers. But many countries maintain a 20% threshold. Let it be known in the US and the UK, the threshold levels are higher. Okay, but here we maintain a 20% threshold level. Okay? So if I place 10% equity with a given investor group and the rest of the equity is held by thousands of dispersed shareholders, it makes it very, very hard to acquire me. Okay? Staving off acquisition. Finally, dividend reinvestment plans, as I said, are just a mechanism through which people can choose to accept choose to accept shares instead of dividends. They can convert their share dividends into new shares. So if they're to receive a dividend in a given interval, rather than receiving that, they can choose to receive shares instead. Effectively, they're reinvesting the money in the company. Some basic metrics, we can move on. That's a rather simple diagram. Right. Okay, the second point, market turnover should actually be market capitalization. I thought I corrected that, my apologies. So that second point there on this slide, referring to the secondary market role, market turnover should actually read market capitalization, so please make that correction. All right, so the stock exchange facilitates the trading of existing securities. It's essential that you have deep and liquid. It's essential that you have deep and liquid secondary markets to provide a surety to the primary market. I can recall when I worked in Vietnam initially and when I worked in India a number of years ago, just how different the markets were in those countries back then. Vietnam was a dynamic market, and I felt that people really weren't paying it enough attention. It was a remarkable market in terms of the opportunity that it presented. One of the fastest growing in terms of production in the world at that point in time. And it's actually led economic production rates 2 years out of the last 10. That's pretty impressive, right? The reality was people were unfamiliar with the market and they just weren't pursuing opportunities within the market as a consequence. You move forward 10 years, wow, Vietnamese IPOs are doing really, really well now. People have enough confidence in the market that they want to invest. Look at Chinese IPO activity. I keep harping on this point, but it's a really big deal in my view. There are over 1,200 firms waiting listing in China. 1,200. 1,200 good, viable, well-capitalized enterprises awaiting listing. Okay? That is more than we have listed in Australia, if you include their existing listings. All right? That's remarkable. It represents a remarkable opportunity. All right. That opportunity is the reason that people pursue those markets so fervently at present, and I keep emphasizing the opportunities in BRIC economies, Brazil, Russia, India, and China. But you need a viable secondary market. One of the challenges with some of these markets is that often there is less assurity around foreign ownership levels, and often people have a level of consternation about owning equity in China and India because they do worry about whether government will potentially want to renationalise, for argument's sake, key utilities. But the Chinese government has been really, really good at allaying any concern in that respect. And so increasingly, we're seeing huge quantums of money flow into China from abroad, to the extent that it's allowed. Obviously, there are international investment restrictions still in place. All right. Let's take a moment to consider the derivative market role of the stock exchange. I think this is an important one and where you can all bring a lot of value because, for the most part, people don't want to learn about derivatives, but I think that they're interesting. Let's take a moment and consider the word. What does the word derivative suggest to you? When you see that word, what does it connote? What does it make you think about? Exactly. So the word derivative, what sort of springs to mind for me is this notion of procuring or attaining or acquiescing to, garnering, benefiting from something else. All right? So when you see that word, that's what you need to be thinking about. A derivative derives its value from something that has actual value. Okay? A derivative is a synthetic security that is not valuable in and of itself. It's valuable because of its association with something else. All right? Again, it's represented often in a very complex way, but for the most part, when you break a derivative down, into its sort of seminal structure, seminal form, they're very simple instruments. I think share-based options are a really obvious case in point. Okay? You can readily acquire on our securities exchange options in the top 20 securities on the ASX. If you want to buy options on NAB shares, you can do so quite readily, and generally at 3 different levels. Now, you'll have some that are closer to the money and some that are well out of the money. What does this derivative security present to you as an opportunity? Well, there are different categories of derivative. The options are undeniably the most beneficial. An option contract provides you with the right but an obligation to acquire something at a predetermined price at a predetermined point in time. All right? So an option on a NAB share is compelling to the extent that it allows you to lever up or ratchet up your return. Consider 2 equivalent positions. I can choose to invest directly in a $20 National Australia Bank share, or I can buy 20 options in National Australia Bank shares at $1 an option. Let's say, for argument's sake, the share price is currently $20, and I acquire each of these $1 options rather than acquiring the security directly. All right? If they are at the money, or at the money meaning at $20, they don't have any inherent worth beyond their time value. If they're at the money at the time that I purchase them, if nothing else happens over the course of the next 12 months, assuming they're a 12-month option, I'm not going to get any benefit, and I'm going to wish that I didn't engage in that transaction from a speculation standpoint. But if, for argument's sake, from a speculation standpoint, I invest in those options at the money, and the share price rises to $24, consider my conceivable return. Okay? I've lost $20, but I've made $4 on every option. Okay? So I've essentially made $80 less my $20 option cost. That's a substantial gain. If I'd chosen to invest directly in an option, invest directly in a share rather than an option, I would have made a gain of $4 on that share. But the risk-return profile is very different. One allows me to ratchet up my return with great risk, which is often why options are strongly aligned to what people would consider a hedge fund to do. The reality, there's far more complexity to it than that. But when you think of a hedge fund or you think of a complex investment strategy, you think of the use of options because they allow you to ratchet up your return. A very different risk-return profile, let that be clear. So they're the simplest derivative contract, but there are other derivatives. There are futures contracts, which don't provide the same level of cover. A futures contract is like lack of a description. It hangs as a sort of Damocles above your head. It can either work in your favour or it can work against you. All right? A forward contract is like a non-standardised futures contract. It's more over-the-counter and more structured. And finally, we make reference to swaps. Just so it's well framed in terms of your understanding, let's consider an example. with reference to a futures contract, because a futures contract is materially different enough from an options contract to warrant attention. All right, so an options contract will only be exercised when it's beneficial to you. In every other instance, you'll choose not to exercise, and the only cost you will incur will be the cost of the option. A futures position is very, very different because it doesn't provide the same asymmetric cover. Okay? In fact, it opens you up to loss. So consider, for argument's sake, an example involving gold. We've used gold as an example on a few occasions in this course. A jeweller in India, for argument's sake, might want to acquire gold in the future because they want to fabricate a huge amount of jewellery to supply people with during the Indian wedding season, for argument's sake. All right? If they acquire the gold now, it's going to result in a gold holding cost, and they may, for argument's sake, lack the ability to do so now. They're concerned about an appreciation in the gold price. To keep the numbers simple, we'll say that the gold price is $100. All right? To moderate their position, what can they do? Well, they can enter into a gold futures contract position now. They can buy at $100, and if the gold price appreciates to $120, when they close out their position, when they sell, they're going to make a gain on the gold futures contract. When they go into the market and they buy physical gold, gold will be more expensive. All right? So gold is actually going to cost them more, but they're somewhat okay with it because they've made a gain on the futures contract to hedge their physical gold position. The challenge with a futures contract is that it can work against you. What happens if, for argument's sake, you choose to invest in a futures contract position, you choose to take out a futures contract position, gold price is 100, but in a somewhat unanticipated event, the gold price falls to $80. All right? Under those conditions, you've bought at 100 and you've sold at 80. You've made a loss on your gold futures contract. But the reality is physical gold will be costing you less money. So you're in a similar position, the position that you were in before. You'll make a loss on the futures contract, but you'll make a gain in the physical gold market. Both positions are equivalent positions. However, in the latter circumstance, you would have preferred not to hedge. You would have preferred to go unhedged. That's a simple example, but hopefully it conveys to you what hedging and indeed the use of derivatives is all about. They can be used for speculative purposes, akin to the example I initially presented, or for hedging purposes, akin to the futures-based example. All right. I'm just going to highlight a couple of contracts, just for no other reason than I would like to. A warrant is generally an out-of-the-money option-style contract attaching to a debt tranche. Why do I mention it? Because we invented it in Australia. All right, so it's pretty cool, don't you think? We invented a category of security that's quite readily traded. And we are the largest vanilla warrant issuers in Asia. So Macquarie Bank out of Singapore is the largest issuer of vanilla warrants in all of Asia. Very, very popular contract. Very profitable contract for them. What I want you guys to think about before you engage with any of these securities is, my gosh, by jingo, they're issuing these securities so readily. How are they able to do so? If it's at their expense for all intents and purposes, even when accounting for novation. Well, the reality is a substantial number of options are written and are not exercised. All right? That's the reality. Someone's making money from every transaction, even if it's not you. All right. In terms of the interest rate market role of the securities exchange, a number of debt securities listed on the exchange: straight corporate bonds, floating rate notes, convertible notes, and preference shares. You can acquire all of these securities on the exchange. Something to be mindful of, okay? So it's not just equity-based securities, it's also debt securities that are available on market. All right, why do we list debt securities? Well, no one really buys and sells them on exchange. The vast majority of trade is off exchange. We list them on exchange just because it makes them more transparent. It improves their marketability. If you were to buy one, you'd probably buy it over the counter. It's unlikely that you would buy it on exchange. Okay, this is just for your knowledge and for no other reason. The system that we use in Australia is known as ClickXT. It's a computer-based trading system. It facilitate the trade of all listed securities. This same system, or a derivative system, is also used in India and Sri Lanka because they've licensed our system. So that's kind of cool, isn't it? All right. The system that is used here is also used in Sri Lanka and also used in India to an extent. All right. In relation to the clearinghouse system, you need a register to actually facilitate the exchange of ownership. In Australia, we use a system known as the Clearinghouse Electronic Sub-Register System. Okay, the system has also been licensed to a number of countries within ASEAN. And they use it as the basis of their securities ownership facilitation. Sorry?
It's a board governing the...
No, this is actually the system itself. So, for example, when you initiate a trade, you have a broker account with ComSec or some other trading... Sorry?
Demat account. Demat, D-E-M-A-T, like it's a trading account.
Yeah, so yes, so you'll have an account. That account is not actually a QuickXT account. That essentially is just like a layer that sits on top of QuickXT. So every company will build some proprietary software that presents the information a little bit differently. But for all intents and purposes, they will be through the same EDI. Okay? And then, after a trade is executed and consummated through the QuickXT system, you need to facilitate the ownership exchange. Okay? So you have the trade, and then you have the confirmation of ownership. The confirmation of ownership happens through this system. This is the register of ownership. So we call it the Clearinghouse Electronic Sub-Register System. Okay? In addition to chess for equity-based instruments, we have chess for interest-bearing instruments as well. All right, for the sale and trade of interest-bearing instruments. And so it's known as CDI. All right, when it comes to the information role that markets play, it's obviously a critical one. There are different views towards informational efficiency that you'll no doubt be exposed to over the course of your studies. But for all intents and purposes, all we're talking about here is the efficiency with which the markets can represent information. And some argue that some markets are more informationally efficient than others. The ASX is seen to be a very informationally efficient market, just by virtue of the significant number of institutional players that are very active participants within this market. All right. What are some of the types of disclosure that are required? Well, listing rules that used to be moderated through the stock exchange but are now moderated through ASIC relate to key disclosures of material information that must be made to all market participants. Why do we mandate this? Well, this information is critical and it's necessary for you to make trades on the basis of. Yep, sorry? Yeah, exactly. So it supports a good and expedient decision making. So examples include a change in company financial forecasts, the appointment of a liquidator. It should actually be the appointment of any insolvency practitioner. Okay? Any lawful appointments, so receiver manager, a liquidator, an administrator, any of those appointments is material enough to warrant disclosure. Declaration of a dividend, notice of a takeover bid, and disclosure of directors' interests. What I find interesting is that notion of disclosing all takeover bid opportunities. I'm almost certain, and indeed the empirics support the fact that not all takeover bids are disclosed. Okay? They only need to disclose a takeover bid if they believe it to be material, and if they believe it to warrant presentation. So there are many bids that come to them that they don't believe to be material enough that they don't present to market. So if you receive a material takeover bid, then you must disclose it. Okay. When it comes to regulation, it's important to appreciate that there are ASX listing rules, okay, and compliance rules. But they essentially operate now as guidance principles because all of the laws now vest with ASIC. Why have we changed the regulatory model? Well, many felt that the Securities Exchange shouldn't be moderating the activities of other public companies because the Securities Exchange is a public company itself. All right? So there are listing rules, and they are listed on the website, But all of the laws are now moderated for all intents and purposes by ASIC. So a breach of a listing rule will involve a review from ASIC. All right. Yeah, look, that's an excellent point. Most certainly it does, and I guess it kind of speaks to programs of denationalisation that have kind of occurred globally. I guess many economies around the world have not wanted to participate in activities that they consider to be activities that private enterprise should be engaged with. And so the initial push came particularly within key public utilities like telecommunications and water supply and to an extent electricity. Electricity has been a real key privatisation space in recent times. But you'll find rather quirkily the vast majority of major bourses and exchanges around the world are actually privately held. It is a quirky one. I mean, the reality is it probably should be something that's held in the public interest, but it's been private for a number of years now. Another interesting aside, there have been 3 major bids for our exchange. Okay? 2 of them have come from the Singaporean exchange. Why do you think that is? Just because our exchange is a remarkable bridge between Asia and key European markets in many respects. It attracts both segments, and it's a very popular market in terms of trade. Okay? This might be remarkable, I guess, for many to hear, but our currency is the 6th most popularly traded currency in the world. And it's because, in part, of our mining sector and also the level of global interest in Australian equities and Australian investments. So we're a really important strategic zone. We're kind of like what Singapore is in many respects in terms of being a gateway into certain parts of Asia, and what Hong Kong is in terms of being a gateway into China. So we're a very important market from a strategic standpoint. Okay, so this is probably more fodder for discussion than anything that's going to be within the scope of your exam. So just humour me for a moment or two. We operate a national guarantee fund that compensates investors in the event of misconduct by a stockbroker. All right, so something to be mindful of. There are major misconduct rules, and there is a guarantee fund in place in the event that someone is exploited by the actions of a broker. Indeed, not just exploited, mistreated. All right, let's consider the key regulatory agency in the context of this market. That is ASIC. ASIC is the key regulatory agency moderating the activities of the exchange. What are they doing for all intents and purposes? Well, ASIC deals with the creation and sale of new securities. They also deal with all material disclosures relating to companies that have issued securities that operate a public model. ASIC also plays a very critical role when it comes to maintaining market integrity and supporting consumer protection. One of my real concerns about ASIC is that they've kind of been given very limited teeth when it comes to certain categories of instrument. All right? They play a very active role when it comes to shareholder advocacy, shareholder disclosure, actively promoting market participation. But the reality is when it comes to certain debt-based securities, they don't really have the teeth to deal with key issues. So I think I mentioned this week one. One of the major flaws, in my view, with our system is that it assumes an investor to be astute or indeed a qualified or educated, highly informed investor when the investment quantum is in excess of $50,000. And from my perspective, while that improves market expediency and efficacy and efficiency, it's really concerning because there are many substantial mum and dad investors that invest those quantums of money that receive very limited market protections. And it is something that needs to be looked at more closely. We've seen a number of reviews into this issue over the course of the last 5 years. There have been some reforms around disclosure, but they certainly haven't changed the qualifying investor rules to the extent that they need to be changed in my view. There have been changes, but there need to be more. All right, so that is really the extent of what we're going to be talking about today from a theory standpoint. All right. After your break, we're going to go through some more practical examples relating to valuations, how we deal with different business models and valuing different types of enterprise, how we classify different business models, and indeed how we seek to value new valuation constructs like network value. Network value is a very important modern construct that shouldn't be discounted. Additionally, we're going to be talking about something that my former students will love, and that's the valuation of incorporeal and intangible assets. All right, it's important. Sometimes boring things are important. Okay, so we're going to be talking about that as well. And we might spend a moment or two to start talking about your assignments and going through some related questions. All right, so we'll have a break, about 10 minutes. I'll see you guys here at 11:15. Hey, how are you going?
I just have a quick question with respect to the assignment.
Yes.
So, I was just looking at the topic.
No, not at all.
Quantitative metric.
It's mandatory for you to use some sort of analytical method that is encouraged. Yeah, so that essentially just means that there needs to be some sort of framework or method to your process. It can't just be an essay.
Right.
So that method could be, for example, you could apply a lean canvas methodology, or a balanced scorecard, or something. It doesn't have to be quant, but it has to be logical.
Okay.
Like something that is a unifying analysis concept, rather than just being narrative-based analysis. Yes.
Now what are you doing?
Well, there's lots of data here, though.
Yes. As far as I was able to incorporate that was that it was more about the kind of trends that it's been following in the past and also what sort of scope it has. But it didn't really focus a lot on an actual quantitative measure. I mean, there was a lot of other measures that I could possibly use, but there wasn't a quantitative measure.
Well, I mean, one simple quant measure might just be the level of valuation. That would be a good way to sort of explain market scoping.
Okay.
And another measure might, for argument's sake, be, if you wanted to, you could look at market insurance CDOs, because you'll be able to get data on them too. So that's essentially commercialization of microfinance. There's two metrics that you can use again. Not complex stuff, just simple stuff. I think that would be a starting point. It doesn't have to be hugely quantitative, no.
Okay. As long as I'm able to
there are different versions. There's some talk about analytical frameworks that people have used to build the analytical framework. Others will talk about analytical methodology if you've used like a math-based analytical methodology, and some might talk about a regression model that essentially every rubric is based on the method that you use. The wording will reflect that. Yeah. All good.
So I was like, this is what values linked into like proteins. Right, so that's why I think like this is only popular after I just say like how the shoe is called. Yeah, I understand. Yeah. By way of this how valuation of
Check 1, 2. Yep.
I was like yeah, but it's not I'm not about to laugh. I can always add that.
Good or how bad it's going to be. I think it's going to be fine. You're going to do well. All good. Let's put that on.
Is this switched on?
Yeah. I realised that this mic is not working very well.
Yep.
So yeah, I think I have to use the lapel. Because yeah, some of the online students said that it was kind of going in and out.
Yeah.
So at least this way it'll be consistent. So
Hopefully they don't find me screaming.
No, we'll check this out. You're talking to me.
Check. Yeah.
That's too loud.
Put
Don't talk
it
down.
on.
You don't need to talk down.
Check.
Maybe a bit higher.
Yeah.
Leave it higher, but just don't put your head down.
Check. I don't know.
Yeah, just check that.
Cool. All right.
Yeah, that's fine.
I think I sent it across to your mail.
Alright.
I feel like I'm severely underprepared for this.
Diapers preparation. Yeah, I'll just let
Do I state the valuations we're going to cover, or just start off with relative valuation? Explain the two
I
types.
think you can explain like the fact that we use different models. Some of them, just like relative valuation models, are more formative in scoping of high level approaches to ensure that we parameterize things logically. Yeah, would you agree? And we tend to sort of bring it back to more foundational approaches, like earnings-based or fundamental models.
Yeah.
I think that will be helpful because you need to give people a bit of context because this is going to be new to people.
And also state that often in the industry they use both
Yes.
while valuing companies.
Yeah, and it's helpful to use popular culture references, even if people pretend like it's not. You can talk about, when they talk about a good valuation versus a poor valuation on popular television programs, they're often referring to a very simple multiple of between 5 and 7 that they believe to be the basis for,
5-10 times sales or 5-10 times profit. It's a pretty stupid way of valuing a company.
Great. Just a quick intro.
Cool.
Alrighty, so we're going to make a start. In this course, we cover off on a lot of theory relating to markets, but our primary focus is going to be on those foundational valuation concepts that you'll use throughout your financial services careers. Alright, so valuation is critical in the context of finance. So much of what we do is centered around appropriate valuation, sound valuation methodology. And so learning good fundamental approaches at the outset is of particular importance. You'll often find, as analysts, people make reference to the fact that someone has good fundamentals or someone has poor fundamentals. Certainly having dealt with a lot of young analysts, it's often how you espouse whether or not someone has sufficient capability to do something. More often than not, we're making reference to someone's capacity or capability around this particular skill set, whether they understand concepts of absolute and relative valuation, fundamental methods of valuation, earnings-based models, so on and so forth well. All right, so having good grounding is of particular importance. If for no other reason than this, you'll certainly be doing some valuation in your final paper, albeit not very complex valuation. In this course, we focus our attention predominantly on earnings-based models and simple dividend discount-based valuation methods. All right, but to understand these methods, you need to understand the more foundational concepts. And so Calvin and Rahul are going to walk you through some of the valuation methods that they use in the context of the work that they do, but also in the context of finance more generally. All right, so Calvin's going to start with a general summary of relative valuation methods, and then Rahul will be introducing a number of more core fundamental methods that we use more traditionally after framing and scoping our valuation using these relative methods. So the former serves as the starting point in the frame, and the latter is often the picture itself. All right? So with that, I will pass over to Calvin.
Thank you, Michael. So let's start off today with relative valuation. Relative valuation, has anyone heard of relative valuation and what it is? It's just a comparison of two, if not identical, or maybe comparable companies in the same industry or same market. With relative valuation, there are a few ratios or multiples that is used in the industry today. Essentially, it's trying to compare like-for-like companies, whether their multiples are the same, or if they're different, whether are they underpriced or overpriced. Most of these valuations are derived from market values, such as price to book or price to earnings ratios and price to sales. So it's just multiples trying to standardize them on the base of whatever, a similar base of one, or you just divide the market price by its earnings. But there are caveats with this. If your markets are overvalued, then you get ratios that are inflated, and then if your markets are undervalued, your ratios are, again, they're lower than expected. So, valuation multiples. Like I said, there's price to earnings ratios, there's return on equity, there's operating margins, and there's enterprise value. On the slide there's an example of Visa and MasterCard. I'm sure all of you use either one of those every day. With the ratios out there, price to earnings, it looks like MasterCard is slightly more expensive to buy to purchase because you got for every dollar that MasterCard earns, you're paying 20 times more than its earnings, essentially. That's the price-earnings ratio. So by just looking at price-earnings ratio, you can somewhat say that it's slightly more expensive to buy a MasterCard share than the Visa. Then there's return on equity, where it's essentially dividing your earnings before interest and tax divided by the total revenue. Sorry, it's just been really long. So the return on equity is just looking at the return that equity shareholders get after removing all operating expenses. Over here, you can see that Visa and MasterCard, with Visa, it has a lower return on equity towards its shareholders, whereas MasterCard have.
What's the difference between EBIT and EBITDA?
EBIT is earnings before interest and tax, and then EBITDA is you remove the effect of depreciation and amortization, because essentially it looks at the depreciation and amortization effect isn't as much on earnings.
Should you ever use EBIT for evaluation?
It depends on the accounting principles that a company employ. If in case the non-cash expenses are significant, then it makes a significant impact on your valuation multiples, or in this case, fundamental valuation. So this depends on, I guess, the significance of non-cash expenses. The enterprise value is essentially just its market capitalization. It looks at the price of the share of each share times number of shares outstanding in the market. Following which, the use of relative valuation. You can use relative valuation for individual equities or indices. The whole index, like the S&P 200 or the S&P 500 in the US, Nasdaq, and New York Stock Exchange. Whichever index you choose, price-earnings ratio and relative valuation can be used on them. With individual equities, you're trying to find, like I said, comparable companies, at least that have similar growth prospects, similar risk factors, similar fundamentals, similar drivers, just so that you're comparing companies that are relatively the same. If in case you take a tech company and try to compare its PEs with, say, a company that looks at commodities, such as a BHP Billiton or a Google, you'll have two drastically different PEs, but that's also because they're two different companies in different states. One has a higher growth, one's about to or is already at maturity. They also have different risk factors with Google that has different risk drivers, such as tech and a commodity that's really susceptible to commodity prices worldwide. With relative valuation for indices, it's just looking at how expensive a market is. Relatively speaking, developed markets aren't as expensive as getting into developing markets such as India or China, because its multiples are far higher than developed markets, definitely, because that's essentially because developing economies have higher growth rates, whereas developed markets are just tapering off right now. The advantages of relative valuation. It's quick. You said firstly, it's really quick to get your multiples out and really simple to explain to clients as to how you get those figures, rather than run valuation models and tell them what your assumptions are based on those valuation models. These are just formulas that account for two variables in there. So they're really easy to explain to someone that has no idea of how you get those values. So in that instance, it's really easy to explain to someone that has no financial background or knowledge. Then there is because relative valuation uses market values or price. It's really susceptible to market moods, or if you guys have heard the word market sentiment. It depends. So if market sentiment is good, then price goes up and your valuations go up, relative valuations go up. And if it's depressed, then obviously it comes down because price goes down. Everything depends on the market. So this is susceptible to the market, which gives you a feel of what the market has for the company. The pitfalls of relative valuation, because it's linked to the market and gives you a feel of what the market is. It doesn't take into account growth factors or risk drivers. It just spits out a number given two variables, which is one from the market. Either if it's PE, then you take earnings from what the company's earnings are and its current market price, or if it's price to book, then you take its book value and divide it by price. The graph there is just PEs of the S&P 500. That was, if you can see, that was at 2009. That was when PEs hit at the top of 70 odd times earnings, which is highly inflated. And then after GFC, you can see the drastic decline. That's one of the reasons why it is a pitfall, because it accounts for market mood swings. And no one can say whether it's right or it's wrong, because it's relative. You're comparing two companies. You're not getting absolute values for them. You can't say that for a tech company it needs to be 25 times earnings or 28 times earnings, because market moods just keep changing ever so often.
Why do so many of the popular venture capital shows on TV use standard multiples set 5 to 7?
I think you're referring to Shark Tank in this case. In my opinion, I feel that's not a correct way of valuing companies, because they're completely different companies. You can get companies that go from manufacturing to tech to just retail. So they have different risk drivers, and if you don't have industry data backing your claims, then it's just arbitrary number that you come up with. And given that it's a venture capital or they're looking for capital injection and they're not at maturity yet, you're not accounting for growth in that company or the risks in that company. So valuations in that case might be overvalued or undervalued, because there's no set figure of saying that if you're going to take like a company, say okay, for example, if I have a company, a manufacturing company that earns $100,000 a year in profit, and say 7 times my profit is what my company is worth. So that's $700,000 odd. It might be the fact that my company has assets worth over $1 million, but because you're taking multiples, you're undervaluing my company, and I probably will not let or sell part of my company for $700,000. So things like that. It just depends on where you're using them. Be mindful of how it's used and what the company is actually worth. Its intrinsic value, if I may.
So you're saying that relative valuation will be used in swing with other valuation methods. When I think of relative valuation, I think being in private industry, there are no two companies that are exactly the same. So to assume that two businesses in the timber business or in the timber industry are the same is way off the mark. And their organisational structures are different, their IP is different, their skill set is different, their ability to produce product and bring it to market. They can still be in timber, but it'd be in completely different parts.
Definitely, yeah, definitely. That's initially why I said you need to find comparable companies. I mean, in this case, if there are no companies that are exactly the same, you look for ones that are slightly different. Usually in the market, you don't get companies that are the same. Facebook, for example, and Google might be in the tech industry, but their risk drivers are different, their growth drivers are different, their fundamentals are different. But usually investors try to club them together and look at their PEs or their price to book ratios, because you in the market you can't exactly get identical companies. If they were identical, then they wouldn't be mispricing in the market. They'd just be priced the same. given that they're priced differently, means that they have enough differentiation between both companies that you value them a little differently.
Fair to say then this is more of kind of a frame to kind of make sure that you find your more narrow valuation methods
are not too obscured. Yeah. It's just trying to get a rough idea of what a company should be worth. That's why most fund managers, at least in the market, use the relative valuations of index and relative valuations of similar companies that they're trying to value.
As absurd as it might seem, this is actually what happens a lot at a high level.
Yeah.
To narrow things down, happens an outrageous amount, often unfairly, and it results in the exclusion of many, many good enterprises, and unfortunately the inclusion of some others. So it does bring with it a level of risk. How much harder is it to sort of contend with this when you've got a limited subset of information for example, like a private company to unlisted private enterprises? Can you do this then?
Due to lack of information in the private market, it wouldn't be wise to do so. Assumes market is efficient, and given that its private market is inefficient, you can't really use relative valuation in this context, at least.
In the property industry, there's an organisation called the Australian Property Institute, where valuation methods are people who belong to that institute must use certain valuation methods. Why does it exist? Why doesn't it exist in the share market industry?
I mean,
Standardization.
Standardised methods where
Valuation.
okay, you've got differences in different sub-markets, but there are certain methods that should be used in order to.
there are definitely standardized methods that investment firms use. Relative valuation is one of them, but you have so many different models out there that you can tweak things to your liking, and which is the other pitfall, if I may, of valuation as a whole, because you can cherry pick what you want and see figures that you like and put them in your report. Is it right? Is it not right? It depends from whose angle you're looking at. If you're a client and you know the analyst is cherry picking their values and putting it in there, then it's not. But for an analyst, that's usually what they do. They take the best figures, try to justify why they've come up with their valuation figures. So that's the whole thing with valuation. It has a lot of underlying assumptions, without which it wouldn't make sense.
I guess they have a good question indemnity cover, because I guess if a client makes a loss, the analyst is going to be sued.
That's only the case if there's a significant loss of your portfolio. If it's 5-10%, I don't think it's going to make much of an effect. They can just direct it to market swing or just downturn in the market.
Also, if the only way a lawsuit will be established in that case is if a fiduciary interest was, if there was a failure of fiduciary duty. So if they have to show that the analyst or the planner knew that it's not a reasonable ground for investment and did it either for opportunistic reasons or just due to negligence. So that has to be, as long as the analyst believes that this is the best way for the investment to go to, that there are no grounds for legal action. So there has to be a breach of fiduciary.
It feels unfair, but unfortunately you don't get assessed based on the results. You get assessed based on the guidance that you gave, as an informed individual at the time. It feels very unfair. But you're not assessed ex post. You're assessed when you give the guidance then and only then.
So yeah. Right. I'm sure recently you guys have heard Michael covered this in the first half of the lecture, where he spoke about Facebook and how its stock, its market value plummeted by 160 million Aussie dollars. This is just showing relative values of tech stock. In this case, I'm going to compare Google, Microsoft, and Facebook. Essentially, the PE ratios are obtained by dividing the price per share by its EPS, and that's where the bottom value comes up with its PEs starting off at 20 and then going off, topping off relatively about 65. With Microsoft being a tech company, in my opinion, I thought it would be a good company to compare against Facebook and Google, because they might not be identical or exact copies of one another, but there's enough there for me to justify that I can use these values and compare across these three companies. I would like to use the industry, the Dow Jones tech index, but I couldn't find data on their P's, so it wouldn't make sense to just put out a value that doesn't exist. This is the PEs of Google, with again Google starting off at PEs of 35, 30, 32, and topping off at 50, 55 times earnings. So essentially, like looking at the graphs above, if your EPS increases for one quarter or 1 month in this graph, then it sort of lowers your PE for that period, because price doesn't move in line with your earnings. Although it does, but it doesn't move as much. It's not a linear trend, if I may. That's the whole reason why you see, even though at times prices are trending upwards and earnings aren't as good, your PEs go up, which means the market is assuming that there's higher growth prospects for Google or for Microsoft. With Facebook, as seen before, on that period of April 18 is right before Cambridge Analytica's news had come to market, where they used essentially the Facebook's consumer data against us. That's the whole reason why you see PEs dropping, and then it sort of recovered over time. And then the Q2 report had come out, I think, as of a week or two ago, where Facebook claimed that they're going to have higher operating costs, and they missed revenue forecasts, and their growth prospects for the next year or so is shrinking, is what the analysts at Facebook had claimed. So, according to me, I feel that the market is overreacting to what Facebook has published into the market, because looking at their PEs, that 33 times earnings just dropped significantly overnight, if I may, with stocks plummeting 26% from the time of its earnings announcement. So this is the reason why I say that relative valuation assesses the mood of the market, and it doesn't judge a company based on its fundamentals. Facebook might be worth well over $500 billion, but currently the market is pricing it at around $500 billion. So it's just, again, according to my opinion, I feel that the market's overreacting to Facebook's announcements, and definitely it will correct itself over time. So that's all I have for today.
Thanks.
Yeah.
So when we look at market capitalization, obviously Facebook will have net assets
Yeah.
and its valuation according to the market. Is there anything that talks about that gap? So I guess the difference between net assets and market valuation of goodwill. Is there anything in the market that says this is how much goodwill on that valuation?
There really isn't, until you look at their account, their their balance sheet. But even then, it doesn't justify the difference in book values versus their market values.
Price to NTA.
The net.
Price to NTA per share. It's probably, it used to be a really useful measure because it's speaking to asset backing a lot. But a lot of businesses are price to NTA, so it's with Facebook. It scares you.
The whole thing I feel is again it's to do with what the company's fundamentals are and how investors feel how it's going to grow over time, and that's what Rahul is going to cover off as of although they have historical earnings, and then based on those historical earnings they look at how the company grows, and that's how you find terminal value. They might be drastically different from current accounting values. But that's how the market is. That they look at trying to incorporate future information into price today, and that's the whole idea.
All right, so this next segment is actually particularly valuable because you are actually going to be doing some fundamental valuation in this course, albeit fairly simple models under exam conditions. No one's going to expect you to do complex fundamental valuation in your final examination, but you will certainly be using standard earnings models and standard dividend discount models using some basic horizon concepts, all right? So pay particular attention to those segments in particular because it is actually quite relevant. All righty, I'll leave it to you.
Yeah, so we're going to be looking at fundamental valuation now. So fundamental valuation is, as the name suggests, is basically evaluating company based on its fundamentals, and this we'll see what that is actually. So yeah, it was introduced most earliest in probably a book by Benjamin Graham and David Dodd. Benjamin Graham was one of Warren Buffett's mentors, incidentally, and it uses macroeconomic and microeconomic data, so company-related data and the economy, just wide data, to exert a value for a company. So it comes up with the actual number value for a company, as opposed to relative valuation, which doesn't do that. It's an absolute value. So the first fundamental values are the accounting approaches. For those of you who've done accounting, you'll be familiar with most of these words, but it's not used much. It's rarely used, but it helps us find an anchor of what value actually is and where we look for value. So the first thing we look for value is in assets. So assets are anything that provide future benefits for the company. And here, the two assets we're looking at is net working capital and fixed assets and goodwill. You'll notice that most of these are operating or relating to the company directly and are not financing activities. For example, net working capital is all cash except cash and marketable securities and current liabilities. Cash and marketable securities are often not directly related to operations, and it's assumed that they go straight to paying off your financial debt in valuation. So that's why liabilities, the first line, total financial debt, is your long-term debt minus your liquid assets. So your cash and marketable securities there. Liabilities also include your pension and tax liabilities and equity and minority interests. So you can already start seeing a clear line of differentiation between operations and all other activities of the company. This is the most basic valuation technique, which is called the discounted cash flow. So discounted cash flow, you can either use it to value any asset essentially. So you can either use it to value a company or just equity, depending on who you're valuing for. If you're using equity, you're assuming all cash flows is relevant. So cash flows after debt payment and after capex, if you're doing for the equity, and the discount factor then would be the rate of return on equity, because you're looking at what equity holders expect. If you're doing it for the firm, however, you take off capex, but it's before debt. So capex is relevant because it's still a financial investment flow, so it's relevant to the firm, even though it's not relevant to equity holders. So for firm valuation, cash flows are considered after capex, but before debt payments. The rate of discount factor there is WACC. If you're not familiar with that, that is the weighted average cost of capital, which is essentially a average of the debt rates and the equity rates accounting for a tax shield, but you'll probably look at that later. Yeah. And you can also account for growth in this model by just multiplying the cash flows by a growth factor. Now, it's not possible for us to obviously estimate the cash flows to infinity because obviously we don't know that much about cash flows, so we stop at a horizon window. So that's normally 5 or 10 years. So you stop wherever you think your assumptions are no longer feasible, or it doesn't make a difference whether you forecast beyond that point or not. And that after that point, the value is called a terminal value. So terminal value assumes that the cash flow you're going to get at that period lasts until perpetuity. So you can either have terminal value with growth or terminal value without growth. So with growth, the cash flow is just discounted by R. That's the basic perpetuity formula. And with growth, it's R minus G because, again, that's the growth perpetuity formula. So that's terminal value. The other main valuation models you'll probably be looking at is the dividend discount model. All of these are cash flows, but it's just a cash flow to a certain particular person or entity. So dividend discount model and the Gordon growth model looks at cash flow to equity because it's dividend. And dividend discount model assumes that the value of the share lies in dividends. This is useful while valuing equity in firms where shareholders are actually looking for equity. It's probably not useful in early tech firms, for example, which do not offer equity because they have high reinvestment. So that's probably not appropriate. But in probably mature firms which have been growing at a steady rate in the past, you can look at the dividend discount model. The Gordon growth model is essentially just a small difference on the dividend discount model. It just accounts for growth as well. And the terminal value is discounted by RE minus G rather than just RE. All cash flow to shareholders reflects the current trend, which is that firms are tending more towards share repurchasing rather than paying off dividends. That is essentially because dividends are seen as key market indicators because people use the models like dividend discount models. So a decreasing dividend is often seen as a decreasing health in the firm. So firms rather buy back share and regain control of the company rather than offer more dividends. So in that case, if you have a company like that, you would use the all cash flow to shareholders model where you account for both dividends and share repurchases and any other value to shareholders that you can find. Abnormal earnings is assumes that the firm's value is based on abnormal earnings. And abnormal earnings is basically a residual earnings. Is all earnings after you pay off your equity. So the return on equity is multiplied by the common shareholders' equity to get basically what the equity holders desire from the investment in the company. That's the number that they want. That's the profit that they want. Any profit beyond that is abnormal earnings, and that's value creation for the company. That's how much the company is actually growing. So residual earnings is just net income minus the residual earnings on the shareholder equity. And a more accurate version of that, if you're looking at just equity, would be net operating assets, because net operating assets are essentially operating activities are essentially what creates for the company, creates value for the company. Financing activities are often ancillary, and while they are valuable to the company, they don't create value. Operations create the value. So an abnormal return on net operating assets would be the operating income minus the return on equity and the into the net operating assets. These net operating assets are the same assets we saw in the accounting approach. So that's why that differentiation was useful. Return on equity is, so you can either use CAPM, which is the capital asset pricing model. So you use how historically the firm's been performing. So that's beta, this is market sensitivity. So you look, that's taken as the firm's risk, right? And how much the market's been offering typically for each unit of risk, how much return, and then you multiply that and you come up with this is what. There are other ways of valuing return on equity as well. You can value it of retention ratios and payout ratios, but yeah, the most popular is probably CAPM and variations on the CAPM. The next thing we look at is whether these models actually work, whether fundamental models actually work. So Lakanishok in 1994 saw whether they can beat the market by choosing shares whose price is low relative to fundamentals, because that would obviously suggest that the firm is being underpriced. So they made 10 portfolios ranging from value to glamour, value portfolios being where a low price to fundamental ratio and glamour being vice versa. And they found that the value over a 22-year period, they found that value of the value portfolios exceeded the expected return on equity by 3.5%, and glamour was actually minus 4.3% of the return on equity expected. So, and this persisted a 22-year period, so obviously this shows that there are some advantages of using a fundamental model, but there are also limitations. And Benjamin Graham, one of the founders, as we saw, of a fundamental valuation approach, he actually, in an interview to Financial Analyst Journal, said that his valuation techniques probably don't apply as much to the market right now because the markets have become too efficient. Why is this? Because in an efficient market, the market value is the intrinsic value. So if the markets have absorbed all information, there's nothing more you can gain by looking at the fundamentals. You're just wasting time and resources. Sloan in 1996 found that there was a high relation between discretionary earnings, which are things like accruals. For example, your bad debts, for example. So these are estimates, and they can be changed by managers at their discretion. And earnings, for example, can be accelerated. Things like that, as long as there's potential for that, he found that these can lead to higher negative abnormal earnings in the future. However, that opportunity has gone down because Green in 2011 found that hedge funds continuously exploiting this opportunity has made that arbitrage opportunity almost nothing. So this is pretty indicative of the fact that when fundamental opportunities arise, it's often institutional investors and funds that exploit them, and because of that, the arbitrage opportunity often is gone. But fundamental valuation is still useful as a long-term approach rather than a short-term arbitrage approach, because it actually tells you where to look for value and what you use as value. That being said, it has a lot of assumptions, and different analysts using the same data can come up with different numbers just based on their assumptions of how a firm will grow. And there's obviously biases to account for as well. So it's not an exact science. It's more magic than science. But yeah, it's about justifying the value you come up with. Like Calvin said, you come up with a number and you justify it. So so that's fundamental valuation. Thank you, guys.
All right, so we'll do some Q&A, and then we'll take it from there. Yes, of course. Yeah, I'll put it online. I need to put their own ones online as well. Yeah, this one's actually quite relevant to your paper this set, so that's good. All right, so this week is slightly more theory heavy in terms of markets than next week. We're going to be doing some introductory evaluation. Next week is really when we focus a lot more on the metrics. So we'll be doing this in addition to some time series work as well. All right, some time series modeling, always helpful. It's not a course in econometrics, don't worry. So we're not going to be doing any regression in the final program, but you'll be introduced to some key concepts. We'll do some basic things. We might even do a few bits and pieces in Excel just for fun, because it is fun. All right, so with that said, let me just open up some of the questions for today. There aren't too many. Loads. There we go. Yeah, so next week, as I said, is going to be a particularly important one for those of you that haven't done any discounted cash flow analysis before. I know that many of you are BBA and BCom students, so you've probably done a lot of this already. All right, so I'm putting together two sets of readings. One is for those of you that have never done anything in business before, and another for those of you that have, all right? So this is something to be particularly mindful of. I think, look, some of you that have done a BBA before or a BCom before might still benefit as well from doing some of this additional stuff. All right. There we go. Where's my download link? There we go. Again, just wanted to mention, I put together work step solutions for these as well. For those of you that are keen that haven't done any moving averages, geometric averages before. Again, those of you that have, not wanting to insult anyone's intelligence, I just thought it might be helpful. So you can go online and download those. Unfortunately, I've uploaded them in the unencoded Adobe format. I'll need to encode them as PDFs. Unless, of course, you have a copy of Creative Suite, in which case you'll be able to do it yourself. But if you don't, just wait till this evening and I'll fix that up. My apologies for that. Okay. So, a few key takeaways at the outset. As you've probably come to appreciate, the markets are quite interesting and remarkably dynamic, but I think both Rahul and Calvin made some really excellent points in relation to being pragmatic about markets. The reality is, it's a very pseudo-scientific space, all right? It's not a true science. It's a pseudo-scientific discipline. We're applying scientific methods to a very behavioral, non-scientific environment in many respects. So we need to appreciate that there's no singular approach, there's no exacting standard, and everyone does things a little bit differently. What we're going to do in this course, I guess, is come to discover the most appropriate foundational approaches, but many of the things that are taught in textbooks, many of the textbooks that you'll be allocated over the course of your studies in this degree program, I dare say will cover off on things in different ways and in ways that I wouldn't agree with. I would say many of the basic discounted valuation approaches are inherently flawed, and you do need to look beyond them when you get into the real world. And your employers will expect you to look beyond them when you get into the real world. All right, so we'll start with some general theory questions. All right, you will get some theory on your final paper as well, so it is relevant. Just to start with, what are the primary benefits associated with listing on the exchange and what are the disadvantages? So you recall early on we talked about the benefits of the exchange and the challenges associated with listing on exchange. This kind of question is not dissimilar to what you will see, potentially on your quiz or on your final paper for a handful of marks. So what are some of the benefits? Sorry? Transparency, yes, most certainly. So transparency, perpetual succession, going concern. What else? Potentially an unlimited supply of capital for all intents and purposes as well. What are some of the disadvantages? Well, we've talked about the agency problem ad nauseum. We've talked about some of the issues associated with people actively pursuing their own self-interest at the expense of the firm. But the reality is when a firm goes public, there's a substantial amount of compliance cost that attaches to that. And the new model of shareholder accountability that comes with listing is not always helpful. I'll give you a couple of case in points. Dell Corporation. Anyone follow Dell? Dell has done spectacularly well since it's gone off market. Okay? Why is it that a firm can do so much better off market than on? Everyone wants Dell to list again. You talk about all of the major investment firms around the world, they all want Dell to list again. But they were listed, and they only performed moderately. Actually, that's not entirely true. They performed spectacularly well for a number of years, and then performance kind of plateaued. But since their delisting, they've done well. Why do you think that is? What comes with being listed? Sorry? Well, yeah, compliance is a big issue, and the accountability model that comes with it. People expect firms like Dell to pay consistent dividends and to operate in a particular manner. Not every firm is afforded the levity that some tech firms have been afforded in recent years, and even those firms are no longer afforded. The reality is Dell, when on market, was at the behest, within the hands of many people that didn't understand the space that it was operating in. Now off market, Dell is a darling of the IT industry. It's the #1 ranked firm in the world in terms of corporate social responsibility with respect to both the environment and social impacts, in comparison to other firms in the space that are also well regarded that don't even rank in the top 500. It's very, very profitable when it comes to the server tech space, very, very profitable in certain categories of consumer technology, and isn't reliant upon its refresh cycle to generate strong ongoing profitability. It also has a strong enterprise software program to support its new server technologies. Would it have been able to achieve any of these things were it still listed? Probably not. All right? Look, another good example would be what Steve Jobs was able to do with Next PC in the time that he was away from Apple. He was able to achieve, in a few short years, what the firm absent of him wasn't able to achieve at all with the benefit of huge corporate and industry resources. For those of you that are interested, you should look up Steve Jobs' history with Next PC and also with Pixar. Probably some of his greatest work happened outside of Apple. Apple was very, very corporate and is still very corporate now. All right. So, we'll skip over question 2. It's quite a basic one. Question 3, you can look at it in your own time. Let's have a look at question 4.
Sorry, just on that question of listing, there is a bit of a mindset of listed in 5% of the institutions that investors as, I call it maybe an unmeasured, but for those people who exist at the board level and the institutional level.
That's very, very true, and it's probably more endemic here than any other country in the world because we have so many firms relative to our population size. So I guess the remark that's being made for those playing at home makes reference to the notion that there is a limited subset of individuals that appears to populate the board structures of many, many organisations, and it's very, very true of Australia. But that is changing to an extent, and there is more diversity. One of the things that I guess has been quite heartening has been the increase in female representation on boards in recent times, albeit they still are underrepresented on boards. But it does create a very complex model of oversight whereby there are complex vested interests. But it doesn't happen as much in other countries. Have a look at Mitsui, Mitsubishi, look at firms like Lenovo, and have a look at the board representation on those firms relative to others. Very isolated and focused board participation. A really great case in point would be Google's involvement with Apple. How well did that go? Okay, they tried. Worked, for about 2 years. And then there was a very angry phone call made between one member of the board and another while one was at Burning Man, the Burning Man event out in the desert, essentially around the time of the release of the Android platform. So yeah, it's a really good point. Doesn't happen. Doesn't happen as much abroad, but really happens a lot here. I can recall Steve Izard talking about his board involvements. I can recall Steve Izard in the 90s was on about 17 different major boards. Yeah, so a very, very different model here. All right, question 4, theory question. What is the difference between a vertical, horizontal, and conglomerate acquisition? Nice, easy one. Vertical acquisition, horizontal acquisition, conglomerate acquisition. What motivates different models of acquisition?
Similar scale of, similar nature of business.
Okay, so try to unpack that a little bit more.
For example, if Mercedes acquires BMW, it's like a vertical acquisition. Like they're in the same scale of business and they're doing the same nature of business.
Try to think about it, if you can, in supply chain terms. It might help. Anyone have anything to add? So think about it along the supply chain. All right, so we have your supply chain. Look at it as a sort of a vertical representation. Look at it as sort of a linear continuum. All right, so let's, for argument's sake, let's think about the timber industry, for argument's sake. Someone mentioned the timber industry before. So we've got originators in the timber industry. Who supplies the most basic resource in the context of the timber industry? The mills. The mills will supply those that engage in some process of fabrication, wood-based refinement, who provide subcomponents. So for argument's sake, wood is milled. It is then collected by those that use wood in some process of fabrication. So the furniture industry, for argument's sake, might be seen as some sort of centre point in the context of furniture trade. The originator of the resource is the mill. And who might distribute the material furniture resource? Well, there could be retail groups, for argument's sake, that distribute those goods. A vertical acquisition, okay, is an acquisition along the supply chain. All right? If, for argument's sake, you're in fast-moving consumer goods, how can you actually distribute your good? Well, you can distribute your good through retail groups, or you can seek to, I don't know, acquire a distributor and facilitate your own distribution, for argument's sake. A better example would probably be an example coming from the tech space. I like to look at chipset manufacture, okay? The ARM chipset design comes from ARM Industries, a UK-based group, very, very talented group of about 100 old world academics, PhDs that got into chipset design. And they cornered the market in many respects, all right? What do they now do? Well, they license that chipset design to a number of different manufacturers and fabricators, all right? So who makes all of those ARM chipsets that are in your phones? Only a handful of foundries and fabricators make them. So LG and Samsung and a handful of Chinese OEM, ODM manufacturers absolutely dominate chipset manufacture. All right? So the chipset that's within the Apple iPhone is designed by ARM Holdings, is likely fabricated by an ODM partner from China, and was previously fabricated by LG and Samsung. Okay? So in the context of that supply chain, when you think about it, the smartphone fabricator, Apple Corporation, has to work with a chipset designer at the top, a chipset foundry, and then subsequently with a heap of component manufacturers. So the screen in an iPhone is made by LG. Okay?
Like the intermediate product manufacturer and the finished product manufacturer.
Exactly. So if, for argument's sake, Apple Corporation wanted to integrate their supply chain, they would buy the chipset designer or a chipset foundry and start to produce their own smartphone chipsets. That would be a way that they could integrate their supply chain. People always get very concerned when companies integrate supply chains because they're effectively locking people out, but it's smart. If you have sufficient scale, why wouldn't you? Okay? It reduces your margins. Okay? There are only a handful of firms that can maintain programs whereby they do design, manufacture, and, how do I put it, the final finished goods production. So Samsung is one of the few companies in the world that can do that. LG is one of the few companies in the world that can do that. Mitsubishi. There aren't that many firms that can do that. Even firms in India and China struggle with every aspect of the supply chain. Okay? They might be able to do one aspect of fabrication or the completed good, but not every aspect. So a vertical acquisition is along your supply chain. Think about integrating your supply chain. What about horizontal acquisitions? So there's been a lot of consolidation within the carpooling smartphone application space in recent times. A number of acquisitions and divestitures. So Uber has been actively divesting out of a number of Southeast Asian markets and focusing itself very, very strongly on Europe, the Americas, and also to an extent the Middle East. Okay? Why has it been doing that? Anyone follow Uber? Sorry? That's exactly right. It's trying to find viable regional competitors that it can acquire, that it can work with. But some of them are not playing that game, and they don't want to divest. They don't want to sell out to Uber. And so several players have said, we're going to maintain our ownership level. Some of them have said, we're happy for you to play a role in the region, and you could buy a strategic stake, but we'll let you own no more than 5%. When you acquire a rival that's in the same space as you, that's often described as a horizontal acquisition. But the waters are quite muddy now. And so frequently, many modern acquisitions are better described as conglomerate acquisitions. What is a conglomerate acquisition? Unrelated enterprise, buying something just because of its potential. Okay? The firm that I love in the world that I consider to be the exemplar in this space is SoftBank. Anyone follow SoftBank from Japan? Have to love Japanese innovation groups. They will just buy things when they believe them to be worthwhile, even if it's an unrelated enterprise. So SoftBank bought Aldebaran in France recently. Aldebaran makes robots. SoftBank sells smartphones. They're kind of like Telstra. Could you ever imagine Telstra fabricating their own robots? I mean, I would love that, don't get me wrong, but it's an entirely unrelated space. But I would offer that the waters are quite blurred and muddied now. I mean, it's hard to describe anything as a true conglomerate acquisition because within a multi-sided platform market world, everything has a level of association, a level of relatedness. All right. I think a really good example would be an example from a bygone era that went really, really badly, and that was News Limited buying MySpace. Does everyone remember MySpace? Before Facebook? How much did News Limited buy it for? $540 million. How much did they sell it for? A couple of years later, $28 million. It's gone through several sets of hands. Who owns it now? Justin Timberlake, very talented musician, is now effectively the primary shareholder in MySpace, the once powerful MySpace. What does that speak to? It speaks to the fact that conglomerate acquisitions are very, very hard. All right, modern conglomerate acquisitions are very, very hard. Vertical acquisitions are sometimes very, very hard to justify to regulators, but they tend to really drive down costs and are very, very intelligent. But the most obvious and common acquisitions that we see on market are obviously horizontal acquisitions, and they tend to go well if done well. So a really good example would be Tata's acquisition of, who did Tata acquire? Exactly, Jaguar and Land Rover. Two underperforming foreign enterprises, Tata acquired them. They are now two of the fastest growing automotive companies in terms of unit sales improvement within the world, the entire world, not just that region. All right, so vertical, horizontal, conglomerate. Try to remember an example. Always helps under exam conditions. All right, a few more theory questions. As I said today, we shall cover the theory. Next week, we shall be doing more of the valuation. We'll just introduce a couple today. So briefly, what is the efficient market hypothesis? We've only talked about this ever so briefly, so I'll concede that you mightn't all recall this discussion. It was a couple of weeks ago, and we only talked about it briefly today. But what is the efficient market hypothesis? Both Calvin and Rahul talked about the efficiency of markets. Calvin talked about the fact the markets seem to be very informationally efficient, and Rahul talked about the fact it is hard to generate a viable and significant dividend from fundamental market information because the markets are seen to be so informationally efficient. What did they mean when they said that? Well, there are different hypotheses that are presented. The weak form EMH argues that historical price information is represented on market. The markets are informationally efficient with respect to historic price information. The semi-strong form contends that both historic price information and all relevant public information is reflected on market. And finally, the strong form contends that even private information is, broadly speaking, reflected on market. I think the truth obviously lies somewhere in the middle. The reality is it is increasingly difficult to generate substantial returns using fundamental information. But within certain informationally less efficient markets, you can do so. Some markets reflect information less quickly. Okay, if we were to talk about India and Vietnam as recently as 5 to 10 years ago, we would say that they were less informationally efficient. Now they're probably more informationally efficient than the Australian market. All right, so things change. So that's what the EMH makes reference to. It's a useful starting point when explaining how to generate profit from data. All right? The reality is all the technical trading that we're going to be talking about next week is premised by a notion that you can generate profit from historic price information. But the entirety of this theory says that you can't. I'm not a huge believer in technical trading simply because it sometimes just feels like a whole lot of graphical analysis with little kind of underlying science. But in saying that, when it comes to looking at volume activity, when it comes to making certain predictions in relation to price inflection, yes, undeniably, that information is still really useful. Okay? We're going to, even as I said, even though we're not huge fans of those sorts of methodologies in the context of many financial services disciplines, it doesn't mean we're not going to learn about them. All right? All right. So just a couple of things that I sort of wanted to introduce very, very quickly in light of what we just spoke about. You guys have kind of been introduced to some valuation concepts. I'm just going to introduce them again today. We're going to do this, albeit quite briefly today, and then next week we're going to do some slightly more involved examples. But just to start with, thinking about what you just learned from the sessions that Calvin and Rahul presented, let's have a brief look at question 7 and try to apply that logic at a very high level. All right? So question 7 relates to a company known as Blue Shoes Limited. They're a producer of consumer durables. The company has paid a dividend of 50, or will pay a dividend of 50 cents in 7 months' time. The share is trading come dividend. The company is expected to grow at a rate of 20% in relation to dividends. Given the risk associated with the firm, the discount rate is 10%. What is the value of this firm? Well, often at this level and in subsequent levels, you'll be presented with a limited subset of information like this, and you'll be required to complete a valuation. With this information, all you can do is engage in a fundamental valuation. You don't have any market information, you don't have any broader context. All you can do is value the security with the information presented. What I want you guys to appreciate is that the valuation of a firm, in the simplest sense, is based on a very, very simple discounted cash flow premise. Essentially, we contend that a firm's value is a simple function of all dividends that we are yet to receive, discounted back to the present day. That is the simple eloquence of all valuation. We value the firm based on the notion that all dividends that are yet to be received, that are yet to be put into our bank account, into our pocket, determine the firm's valuation. So let's go about doing this valuation, albeit very, very quickly. If we were to conduct this valuation, what we would need to do is make a series of assumptions. What information do we presently have? Well, we know that we're going to receive 50 cents in 7 months' time. That dividend is not in our pocket. If the question had stated we have just received 50 cents, that would make our answer critically different. All right? We only use dividends that we're yet to receive or earnings that we're yet to receive in any valuation. Why is that? Why do we not use dividends that we've already accrued in a valuation? That's exactly right. We've already accrued that value. It does not constitute future value. This valuation determines the present value of all future dividends. So our first valuation element is D0. D0, the notation D0 denotes dividend in year 0. D0 in this context is 50 cents. Okay? We are asserting in the context of this question it's going to grow at a rate of 20% going forward. Actually, my apologies. In this context, 50 cents is actually D1 because we're yet to receive it. So 50 cents is D1. D1 is going to be divided by our required rate of return less our discount factor, our risk coefficient, to determine the value of the firm. It's as simple as that when you're starting out. We then build more elaborate models where we try to project into the future, predict what future cash flows are going to be, determine future dividends, and we discount them individually back to the present day. But every valuation starts here. This is our formative or our scoping valuation. All right? So D1 is 50 cents. In this context, our valuation is simply 0.50 divided by, on this occasion, 20%, 0.20 minus 0.10. It's as simple as that. Your first valuation, your fundamental valuation, is that easy. How would we build upon this model? If we could, what would we do to extend it? That's our scoping valuation. That's our first valuation. What would we prefer to do? If we had the benefit of time and additional resources and the ability to ask clarifying questions, what would we do to make this valuation better? But this is considering everything with a simplifying assumption. So what would we do to make the model better? Well, the goal in any valuation is try to predict as accurately as we can as many different model components in the future as we can today, without bringing undue volatility and too much uncertainty to our valuation. So in an ideal world, we would endeavour to predict the longest sequence of cash flows, of dividends that we could into the future, which more often than not is between 5 and 7 years. It becomes foolhardy to go any further into the future. We would discount those back to the present day and then make a horizon assumption. All right, so the idea is to enhance our model by trying to predict more parameters that improve the accuracy of the valuation. So that's what we'll do next week. So that's enough for this week. So this week is predominantly the theory discussion around valuation. Next week we actually get to do some of the actual valuations. All right? So try to keep some of the learnings in mind. And if you do have a copy of Excel on your computer, if you could try to come to class with your computer, that would be particularly helpful. Or at the very least, bring a pen and paper and a calculator. All right? And please look out for those geometric average calculations from last week. Please go online and download them. All right? You can download them from the homepage. All right, I shall see all of you guys next week. Have a lovely week. Hey, I was at Building M, you didn't come.
I'm very sorry, sir. My health just got screwed up.
That's okay. No, I waited for you, but then I waited for 20 minutes and then I had to go. So I'm terribly sorry for you. Yeah, but today's a little bit more difficult only because I have a medical appointment at 1. But I can certainly chat between now and then.
Just tell me the time.
Yeah, I'll be in the corporate centre for the next hour. In the front building. In the front building, let's go to the top, to the second level. BCC. Okay.
I appreciate the meeting with.
Yes, no. No, I appreciate that. Sorry, it's been a bit remiss of me. I've been trying to put together a slightly more detailed list, but yeah, at the moment, it's probably best to read the chapters in full. But yeah, I'll post a very detailed one. I will. Yeah. Sure. So I'll show you. Yeah, my apologies. I think maybe I thought it was more self-explanatory, but I'll try to open it up for you. Come here. So, this week is chapter 7 and chapter 8. Oh, this week and next week. This week and next week is chapter 7, chapter 8.
How about last week?
Last week is, it's probably, there's 2 chapters that cover it slightly differently, so okay, chapter 17. Or if you want a simpler version, chapter 6. Yeah, so chapter 6 is a slightly simpler version. Chapter 17 is bit more involved, but they're effectively the same thing. So, really like, if you have time, both. But this is the short summary, and the other one is a bit more detailed. Yeah, this only covers it briefly. So, if you come to chapter 17, too far. Chapter 17 goes into between pages 483 and 497. Yeah, that's okay.
Is this possible to give us a chapter that we need to relate it to the topic that you've given to us?
Yeah, no.
And
No. I've been endeavouring to.
topics that are related to what we've
Yeah, the problem is.